Okay, so good evening, class. You're welcome again to another class on corporate reporting. Today, we are going to continue from where we stopped, which is financial instrument. So far, we have understood the background on financial instruments. We understand that um, everything we want to learn here on financial instruments is basically around debt and equity instruments. And from the definition also, even before the definition, I established the fact that we are going to be using two standards to learn financial instruments. And these standards, IS 32 and IFRS 9, and the standard we'll be using to learn financial instrument. IS 32 will take care of definitions, classifications of instruments into liability and equity, and also compound financial instruments. While IFRS 9 will deal with the core accounting around the recognition and measurement, as well as impairment, which we're going to look at today. So we looked at the definition, and you saw that there has to be a contract, give rise to financial assets, financial liability or equity instruments, or another entity. So we have looked at this definition. We have explained what financial asset is, what financial liability is, and what an equity instrument is. We have looked at scenarios to understand that. And we have also looked at recognition of financial instruments. We established the fact that whether either of the party has financial assets, financial liability, or equity, anyone, they are recognized, the recognition criteria is the same. Which is that whenever an entity becomes a party to the contract, then go ahead and recognize um, the item in the books of accounts when you become a party. And I told you become a party either at the date of agreement or at the date of commitment, either one. And we also looked at the recognition of financial assets. So I won't go over this because I've revised this before. So we stepped into measurements majorly last week. So for measurement, we picked each of them one by one. Measurement of financial assets, measurement of financial liability, and also measurement of equity. For financial assets, I already taught you that financial assets are majorly three items: cash, equity instrument of another entity, and also contractual obligation to deliver cash. And when it comes to cash, how do you measure cash? Cash is cash. It's measured at the amount you have either in your bank or your highly short-term investment. So measurement of cash is not a problem. Then the major issue for financial assets measurement is the other two, which is when you invest in shares, that is investment in equity instrument of another entity, or when you invest in debt instrument, which gives rise to contractual obligation to receive cash. Now, we started with the equity, even before the equity instrument. The first thing I mentioned is that all financial assets, they are initially measured at transaction price. That one, you need to know it by heart, that the amount you invested is how much you are going to record it in your books. That is what we call transaction price, all financial assets. Then we narrow down to equity, that when you buy shares, we said that, okay, when you buy shares, we already know that, okay, initially you measure it at the money you paid for those shares that you bought. Then at that date you bought it, you need to do classification. You need to understand why you have bought these assets. Are you holding it for short term or for long term? If you're holding it for short term, you will have to classify it at fair value through P or L. If you're holding it for the long term, you have to classify it at fair value through OCI. That's the classification. And I mentioned emphatically that this classification is done at the date of acquisition of this asset, at the date of acquisition of this asset, that is when this classification is done. And when you do this classification, it's the classification that will determine the measurement at the end of the year. Because at the end of the year, if you had classified the investment in shares at fair value through POL, you measure it at fair value through POL. If you had classified at fair value through OCI, you measure it at fair value through OCI. And the difference is just how you treat changes in fair value. That is just the difference. For fair value through POL, any change in fair value will be recognized in POL. While fair value through OCI, any change in measurement or in fair value will be recognized through OCI. And we looked at some examples last week on all of this. Then also, I introduced transaction costs because usually when you want to buy shares, you will use a stockbroker. And I told you that if you use a stockbroker to buy shares, how do you treat that transaction costs that you pay or the agency fee to the stockbroker? I say, of course, you credit bank because you are paying money. But what would you debit? Some of you said you debit the expense. Some say you debit the asset. But I told you that the treatment of that transaction cost will depend on the classification of that financial asset. If you classify the financial asset at fair value through P&L, the transaction cost will be expensed. But if you classify it at fair value through OCI, the transaction cost will be capitalized. And that was it for equity investment. We also went to debt investment. But for debt, it's majorly when you lend somebody money. And it's usually through a debt instrument like this dollar bond of the federal government of Nigeria. If you buy it, I mean, the minimum you can invest that in, I think it's $10,000. And the interest rate per annum is around 9.75%. So it's very attractive. If you invest there, that's a financial asset. So initially, is how much you have invested that you recognize in your books. And also, based on what I taught you for debt, immediately you have acquired that asset, you need to determine your reason for buying. You need to classify that debt investment. And I told you there are three classifications: amortized cost, fair value through POL, fair value through OCI. Now, and I told you that this classification, the basis of this classification are two. You need to establish what's the business model of this company, and also you need to establish the contractual cash flow, right? Contractual cash flow. And I told you that business model in this context means that how do we want to make money from these debt investments? And there are two ways, Number one is just solely to collect interest and principal. And number two is to collect interest and principal and also to sell the financial assets or debt investments if there is opportunity for higher yield somewhere else. Now, but the second one, the second basis, which is contractual cash flow characteristics, that one is a permanent feature in almost all debt investment, because what that means is that there has to be a contract that will state that, okay, we want to will state that we want to, that there is a contract that will collect interest and principal. There's a contract that will collect interest and principal. And I told you that before you can classify at amortized cost, the business model must be that you solely want to collect interest and principal. If you want to classify at fair value through OCI, the business model must be that you collect interest and principal, and you also have intention of selling if the opportunity arises. If the opportunity arises, you can also sell. I've seen a question, one of your past questions. If you check this, your handout, there was a guy, they said that, this guy, he bought debt investments like federal government bond, he invested in it. Then, like 5 years ago, he sold small 2% of that investment. After that 5 years, he has not sold again. He did not sell again. So then I ask you, how would you classify this? If you say amortized cost, you are wrong, because you would be tempted to say, Shibi is just 2% sold, even 5 years ago, that he has not sold since, right? So the answer is fair value through OCI, because even though he has not sold since, he has been holding that investment and hoping he will hold it to maturity. For the fact that he has sold before, I'm sure he will sell again. If he all he needs is just appropriate compensation and appropriate yield, he will sell. So the answer for that is this asset or this financial asset should be classified at fair value through OCI. Now, for fair value through POL, I told you this is just a default classification. It's a default classification. So in fact, most financial assets should be measured, if not all, at fair value through POL, except if you can be measured at fair value through OCI or fair value through or amortized cost. So fair value through POL is default classification. So there's no basis for that one. You can decide, okay, I want to measure that fair value through POL. Now, that's all for financial assets. And again, lest I forget, for debt investment also, I told you that if you incur transaction costs, I mean, when you would use a stockbroker and the guy charged you money, how do you treat that? Of course, you credit bank, right? What do you debit? Are you debiting the financial asset or P&L? That also it depends, right? So if it is at amortized cost, you debit the financial asset. That if you are classifying it as amortized cost, you debit the financial asset. If you are classifying it at fair value through OCI, you also debit the financial asset. But if you are classifying it at fair value through POL, it goes to P&L. And you should have a pattern here. That is only when these financial assets are classified at fair value through POL, that's when you would expense the transaction cost. And that was it for financial assets. Then for financial liability, I told you basically, initially is measured at net proceeds, or of course, transaction price, because here you are borrowing money. Sorry, yeah, you are borrowing money. You are borrowing money. So we say initially is measured at net proceeds. Net proceeds in the sense that if you had to involve a stockbroker to help you borrow, the guy will collect money, he will charge you. So if you are raising 100,000, the guy said he will collect 10% though. All the guy will hand over to you is 90K. He will not hand over 100 and will start pursuing you for his 10%. No, he's one that will help you collect the money. He will just give you your net. So that's why initially financial liabilities are measured at net proceeds, right? The money that came into your hand. However, if that is not present, then it will be measured at the transaction price. So financial liability is that initially, and is classified and measured at amortized costs, majorly for financial liabilities. Okay, and I took my time to also explain amortized costs, right? And where the key amortization arise, where that name worked, is a situation where there was a premium, where we are collecting back our principal at premium, and also where there is transaction cost. I did some examples with you guys to show you how amortized cost will be determined, whereby they will give you an effective interest rate, because they will give you an effective interest rate, because what income in the case of financial assets that will be earning is now beyond the nominal interest rate. And in the case of financial liability, the interest you have to pay is now beyond the nominal, because there are further costs attributable to collecting or raising the money. So they will give you an effective interest rate, and that effective interest rate is what will be recognized in POL. You solved several examples last week to address all of that. Then there is equity instruments. I mean, I'm not sure I mentioned this because the standard didn't really touch on measurement of equity, because this one is country based. Each country has different basis for measuring equity. In Nigeria now, equity here is just share capital. In Nigeria, your share capital is measured at nominal value. Nominal value. It's always a nominal value. So if you now issued your shares above the nominal value, the excess will even go to share premium. So very straightforward. And where do you get nominal value? Theoretically, they will give you in the question that is the nominal value of the company. Practically, you will have to ask for the CAC document of the company for you to be able to get the nominal value. Okay, so, and we have also solved some questions together in class. Now, what I want to achieve today is this. Number one, I want to look at a scenario whereby we would have, we borrowed money. We actually borrowed money, but we now give the investor option to convert to shares. I'll look at that scenario very briefly. I think I've looked at it with some people. I'll just quickly revise it again, very straightforward. And also, I'll also look at this financial asset, that what happens if we lose our investment? What happens? How do you treat that loss? Okay. And hopefully, I might also look at fair value measurement. So very short topics, very short transactions I want to look at today. So let me start with that of so I need you to just tag along with me, even if you have had this before. Just listen to it again. It won't take me 10 minutes to actually sort this convertible instrument. So you see, in summary, this is what is happening here. So a company borrows money, right? They borrow money, and this money they borrowed, it has conversion option. It has conversion option, which means that those people that gave us the money, those people that lend us money, we are telling them that at maturity, you can either collect back your money or you convert it to shares in our company. That is, you become a shareholder in our company. That's what's happening here. So there's a convertible instrument. So usually in the exam, they will call it convertible bonds, or they might call it complex financial instrument or compound financial instrument. Okay. And another thing is this. You will see from my explanation, this kind of me as an investor, if somebody gives me that offer that, okay, I should borrow him money, but at maturity, I can either decide whether I will collect my money back or I convert it to shares. I think I would prefer that to somebody that just said that, okay, I should borrow him money, he will give me back my money. I would prefer the guy that has given me a conversion option. I'll prefer that one. And any rational investor will prefer that. And do you know why? The reason is that I'm safe. I am safe in the sense that the credit risk is lower, because in case of defaults that this guy cannot pay back, I know I will have shares. It's different from the one that is just blank, that okay, he promised to pay back. He now failed. That one that is a total loss. So because of the attractiveness of this of transaction to investor, you will find out that the nominal rates will be lower than the market rates. Of course, the lower the risk, the lower the return. So you would see that in questions, right? So now, let's go to, that's the scenario, really. So the major thing is this, the major thing is this, before I go to a question very quickly, is that now, how do we account for this? It's nothing new. When I borrow money, you see, to prepare your mind, I'm looking at examiner will only ask you questions from the standpoint of the issuer, the person borrowing money, not the standpoint of the investor. No, we will not look at that because the investor, financial asset to him, nothing more. So the examiner would ask a question from the standpoint of the issuer. Now, the thing is that, okay, I've collected, let's say I borrowed 100,000. The accounting entry is I will debit bank and credit financial liability, right, with 100,000. If you do that, it's wrong. It's wrong because there is a possibility that these people might decide to convert to shares at maturity. So I can't entirely just call this item a financial liability because there is an element of equity there. But because I am not sure, I don't know whether what the other party will do, whether they will convert or not. IAS 36 says that you need to then consider elements of the two. So whatever money you have collected, you need to separate it into liability and equity. And how do we do that? Similar to what we did under choice of settlement in IFRS 2, you just need to determine the value of the liability first. When you determine the value of the liability, whatever is remaining is equity, and you're done. That is it. So that's all we want to look at here. So let's see how we do that with a question. This question talks about Ferry Limited. Issues 4,000 convertible bonds at 1st January 2021. The bonds have a 4-year term and are issued at par with a face value of 2,000 per bond, giving a total process of 8 million. Interest is payable annually in arrears. Nominal interest rate is 6%. Each bond is convertible at any time up to maturity into 250 ordinary shares. When a bond are issued, the prevailing market interest rate for similar bond without conversion option is 9%. What is the value of equity? Okay, so this question is direct. What is the value of equity? You will see that Ferry borrowed money. When they say issued, it means he borrowed money. And he borrowed money on 1st January 2021. And each of these bonds is valued at 2,000 naira each. If you multiply 2,000 by 4,000, that means the total money he borrowed is 8 million. He's going to pay 6% interest. And they said each bond is convertible into shares. Okay, that makes it a compound financial instrument. And the fact that it's convertible. You will see that the interest rate of a similar debt without conversion option is 9%, which is higher than what we are offering of 6%. Like I explained earlier, this one with conversion option, it's more attractive to investors. So they are ready to take a lower interest rate. So how do you get the value of the equity component? Now note that the separation will be done on initial measurements, initial recognition, the date, which is 1st January. And the first thing we need to determine is the liability component of this 8 million. As soon as we get the liability component of this 8 million, the balance is equity. So how do we get the liability component of 8 million? All we need to do is just to get the present value of the interest and present value of the principal. Since we are giving 6% per annum on this money we borrowed, that means the interest per annum is 480. We need to get the present value of that. And by now you should know that whenever you want to get the present value of equal annual amount, you use annuity factor. And this is the formula for annuity factor. 1 minus 1 plus r is per minus n divided by r. If you punch your calculator where you see r as a 9%, please don't use 6% as a discount factor. You have to use the market rate. R is 9%, which is the market rate. N is 4 years, right? If you punch down your calculator, it gives you this 3.24. If you multiply this 2.24 by 1.5, you would get, if you multiply this 3.24 by 480, by the annuity, that gives you 1.5 million. You also get the discount factor or the PV of the principal too, which is 8 million. This is the principal at maturity. So this principal will be paid in year 4. And that's why this one is coming as 4. 4. This is year 4. 8 million. You need to get the present value of that today. That you use discount factor. You won't use annuity factor for that. Annuity factor is when you want to get the present value of annual equal payments. That's when you use annuity. You use discounting when you want to get the present value of a future payment. So since we are paying 88 million in the next 4 years, so the present value of that, you use 1 plus r raised to power minus n for that. If you punch that on your calculator, where r is 9% and n is 4 years, you get 0.708. If you multiply that by 8 million, it gives you 5.6 million. If you add that to this earlier one for the interest, it gives you 7.2 million. And this 7.2 million is the value of the liability at initial measurement. So out of this 8 million, which is the money we borrowed, 7.2 million relates to liability. That means the balance, which is 780,800, relates to equity. So at this date, the date we borrowed money, the way we are going to enter is 8 million in our books. We debit bank 8 million. We credit the financial liability amounts we got up here. Credit the equity with 788. That is all for this question. Let's look at another question. It says that a company issued 20 million of 4% convertible loan note at par on 1st January 2021. The loan notes are redeemable for cash or convertible into equity shares on the basis of 20 shares per 1,000 of debt at the option of the loan notes holder at 31st December 2024. Similar but non-convertible loan notes carry an interest rate of 9% required. Show how these loan notes should be accounted for in the financial statements at 31st December 2021. Okay, so very similar question, but if you look at the requirements here, it's quite different from the first one. This one is requesting that we should show how this loan note will be accounted for in the financial statements at the end of the year. So in this question, you would have to prepare financial statements. That's the difference between this one and the first one. So you will see that this company borrowed 20 million. It will pay 4%, and they have already specified that as a convertible loan note. Now there's a conversion option. And they borrowed it on 1st January 2021. And they told us that is either the guy redeem cash or convert into shares. And they have told us the basis of conversion. Then they told us that similar but non-convertible loan notes carry an interest rate of 9%. I already told you that this one which is the market rates, the rate will be higher than this one here because this one here is more attractive. So similar to what we did in the first question, the first thing we need to do is to split this liability, this money we borrowed, 20 million. You need to split it into liability and equity. And how do you do that? You determine the liability first at the date you borrowed money by getting the present value of the principal and also the present value of the interest. So since we are paying 4% per annum on 20 million, so we will be paying 800,000 per annum. If you get the annuity factor, since it's 9% and also 4 years, so it's 3.240. I've told you the formula for determining that is 1 minus 1 plus r raised to power minus n divided by r. If you punch your calculator, it gives you 3.2. If you multiply that by 800, you get 2.5 million. You get the present value of the principal too, which is 20 million. This will be payable at maturity, which is in 4 years. The present value of that is 0.708, which is 1 plus r raised to power minus n. R is 9%, n is minus 4. Punch your calculator, it gives you this. If you multiply this 0.708 times 20 million, give you 14.1. When you add it to the PV of the interest, then we have the value of the liability. By the time you take that away from what we borrowed of 20 million, the balance of 3.248 thousand is the equity. That is, the date we borrowed money, we'll simply debit bank with what we borrowed. We credit liability with 16.7. We credit equity with 3.2. So at the end of the year, not 2021, 2020, yeah, 2021. At the end of 2021, the financial liability, like you already learned, are measured at the end of the year at amortized cost, if you remember. And how do you determine amortized cost? But the balance brought forward is this. This is 10.7, balance at the beginning. Then, since we have a market rate, that's the effective interest rate. So that will be the interest payable. That's 9% on this 16.7. That's what we'll add. That's what will go to POL. This amount that goes to POL. This all goes to POL. But out of this 9%, what we actually paid, based on our agreement, is 4% of what we borrowed, which is 800. So just like I've taught you under amortized cost, sometimes you add this to this, then you remove this, the balance gives you 17.4. Then my P&L, what goes to my P&L is majorly this finance cost, this interest payable of 1.5. In my statement of financial position, in my liabilities, not current liability, my convertible loan note to be 7.4, which is this. This we got here. Then under equity, I have equity reserve of 3.2, which is the balance here for my workings up here. And that's the end of this question. Now, if I move to this one very briefly, I need to ask you a question. So this 1.5, right? I said this is the effective interest rate, just like I've taught you already, that obviously we are paying, we pay, it's payable, so we debit P&L. Where would the corresponding credit go? Anybody? Where would the corresponding credit go?
Unpayable.
Thank you very much. That's correct. So you credit the financial liability. What about the 800,000 that we actually pay? What's the double entry for that?
Crediting cash. You are
Okay.
reducing the liability. You are
Thank you
debiting
very
the
much.
don't pay.
Thank you very much, Robert. So that's correct. Okay, good. Now, very quickly, I need to point this to you that really when interest, dividends, losses and gains relating to financial liability goes to P&L. Majorly, they go to P&L. But when it comes to returns to equity, okay, like dividend we pay to shareholder, those ones we debit them directly to equity. They don't go to P&L. That's why you find that dividend are always recognized in the statement of changes in equity, not P&L. Also, when you raise money, if you are the issuer of shares and you incur some costs, you don't expense it. It doesn't go to P&L. See, when you credit bank, what you debit is the share premium account. Okay, when you raise money through shares, and of course, mostly you would have the finance houses and the underwriters that will be involved and all of that. So The money you pay to all of those guys is transaction cost. You debit them to share premium. I don't need you to note that. So I have here a series of questions that have been asked before by ICANN in the past.
Please, can you go up? Can you go up? That transaction cost. If you go
Okay.
up, just yes, please. The transaction cost of an equity issue. I'm just wondering, I'm trying to reconcile that with what you said earlier on, where we're classifying transaction costs separately, depending on whether it's fair value via comprehensive, other comprehensive income or POL. And we talked about capitalization of one and expensing of one. So where does this fit in now
Okay,
regarding
good.
this transaction cost?
Yeah. So those ones are financial assets where you just buy when you are the one buying shares, you are the investor. That's when that one applies. So what I'm talking about here is where you are the one that have the share capital. You are the company that is raising money.
Okay, fine. Yeah.
Mm. Okay. So I kind of asked financial instruments severally in the past. One of them is, if you look at this requirement here, they said discuss briefly how debt investments should be classified by the bank in accordance with IFRS 947 marks. And if you read this entire thing, you will see that if I start from here, which is the relevant one, this bank invested in debt, FGM bonds. I've given you this scenario before. So they said the strategy is to hold to maturity and receive interest and principal. That's their strategy. But they now said again that the bank is known to sell. Sorry. So they now said again that the bank is known to sell some of these instrument power to maturity like that. So, I mean, that one is a deal breaker for us to classify it at amortized cost will be a deal breaker. Because for the fact that these guys is a financial asset, fine, they is in debt investment, but we have to classify it at fair value through OCI because they have a history of selling. They can sell again. So the fact that they said their strategy is to hold to maturity, but they sold. They sold. So for that reason, classify that fair value to OCI. But in order to get 7 marks in a question like this, you need to write first, you need to state the principle governing classification of debt investment. First, you need to explain it that uh, debt investment here will be classified either at fair value to OCI, fair value to POL, or at amortized cost. And the basis of classification is the business model or the contractual cash flow. You now go ahead and tell us that you can classify at amortized cost where the business model is to collect solely interest and principal. And of course, there have to be a contract that will state that yes, you will collect interest and principal. We go to the next paragraph. That you classify at fair value to OCI, where the business model is to collect interest and principal and also to sell. And of course, there has to be a contract that will state that you collect interest and principal. Then you state that, okay, fair value through P&L is classified as a default classification. Is a default classification. That's the first thing you need to do first. That's why they allotted 7 marks. So this 7 marks is not for you to just say that, it will be classified at fair value to OCI. You're not looking. You not get 7 marks, so you only get 1 or 2. To get 7 marks, you state the principle clearly. Then you can then go and say, okay, from the case, from the question, yes, their strategy is to hold to maturity, but they have a history of selling. That means they can sell if they have the appropriate incentive. They can always sell. So for that reason, we'll classify it at fair value to OCI. So this one was in March during COVID period. And there was another one in November. This one, if you look at the requirements, they say you should advise the management of Muzana based on IFRS 9, the recognition rule, if the loan ability can be recognized in their year end September 2019 in the financial statement. So based on IFRS 9, the recognition rule, if the liability can be recognized in the financial statement. I think I've given you this example before. So there's this guy that borrowed money. So he collected a loan of 100 million in 2016 for 5 years. At the end of the third year, the guy has already set aside that money. And he's ready to pay, but he did not pay. He did not pay. So what the guy now did in 2019 was that since he already has the money, though he has not paid, though, he derecognized the loan due to the fact that the funds have been set aside in full to satisfy the loan in 2020. So you are now asked to advise him. So again, these 7 marks. For you to get these 7 marks, the first thing you need to do is to state the recognition principle. That's the first thing you need to identify first. And what's the principle? Financial liability is recognized when it is extinguished, when the obligation has been extinguished. That is, discharged, cancelled, or expired. You now go to the case. Now, from the case above, this liability hasn't been extinguished, that is, discharged, cancelled, or expired. What the company has only done is to set the money aside, which does not translate into extinguishment. For that reason, the Muzana is advised to continue to recognize the loan ability until it is extinguished. That's how you answer question of this nature. Then, and there are some other ones that you can also go through here. Now, still on financial instruments. So this is a very short one. I'll just need to tag along. Those, I know you're tired, so I'll make it quick, but depth in depth. So now, the core principle here is this: impairment of financial assets. You see, first, let me just tell you what it means in layman terms, in a very simple term. What it means is that we have lost our money. That's what impairment of financial asset means. We have lost our money. We have lost our investment. So that's what we want to learn how to account for. Loss of investment. However, the way I've just explained it to you now was the way we used to see it before, which is incurred loss model under the old or defunct IAS 32. We used to use an incurred loss model. But experience has shown that waiting till you lose the money before you recognize impairment is not good for users. It's not good. It's not good. Don't wait until you have lost the money, because the reality is that when you invest, somebody that is supposed to be paying interest, you will have been defaulting. You will have been showing sign. You just choose to ignore. So the due date came for you to collect interest. They did not pay. And you are accruing for it. A lot of banks then, they were having interest income on loans that are already bad. They saw it that these guys are not paying. They are still accruing for income. They are accruing for income. It resulted into serious problem, a serious problem, right? So this cannot work. And don't forget, always remember that when we talk about financial assets, we are talking about cash, equity, investment in equity, and also investment in debt. The only one that can impair in those three is debt. Cash cannot impair, except if you have money in Heritage Bank. Sorry to say, that one has been impaired. But all things being equal, your money, your cash cannot impair. You should be able to walk into your bank and collect your money full. Equity, shares cannot impair, except if the company liquidates and fail. It cannot impair. So the only thing, what this one relates to is debt. When you borrow somebody money, that's the only one where somebody can default. So that's what this relates with. So let me just go straight to the point. We are not using IAS 39 again. We are using IFRS 9. And under IFRS 9, we use what we call expected credit loss model. As the name implies, don't wait until you have lost your money before you start recognizing impairments. Don't wait until the money is gone. That is now everywhere. That this company cannot settle his debt again. No, before you can now say, I've lost my investment. Though. No, don't wait. As soon as you see signs, even before you see any sign, expected credit loss model here is saying that you must expect that there will be credit loss. And again, for simplicity, this credit loss means that, okay, you will not collect your money. Okay, just for the purpose of grammar, it's just the difference between the PV of contractual cash flow and expected cash flow. So your contractual cash flow is what you're expecting to get, like what you should get based on the contract. So if what you should get is, let's say, 50,000, but because of several events, what you might get is, let's say, 40. That means credit loss or cash, they also call it cash shortfall, is 10,000. Okay, that's credit loss. But that's not where I'm going. That's not where I'm going. I want to narrow your mind down to something. So the first thing I've been able to pinpoint here is this. Expected credit loss model is a model whereby we don't wait until we incur credit losses. We don't wait until we lose our money before we start recognizing impairments. Okay, so how do we then do it? I will explain that to you very soon. But before I explain that to you, this ECL model, we usually shorten this expected credit loss. We call it ECL, expected credit loss, ECL. You see, this ECL, there are two types of it. Two types of that. It's just to make it easy, because the fact that we have not lost, the money is not lost yet, right? So it means that we'll just be making an assumption that, okay, let's assume we will lose some of it, because you might not lose it eventually, right? So it has to do with a lot of assumption. In order to narrow your assumption down, so this ECL, I'm going straight to this place. This ECL now, is classified into two. Number one is lifetime ECL. Number two is 12-month ECL. And I would break this down to you like here. Let me start with lifetime ECL. So this one, you are saying that, okay, the possibility that you will lose your money over the life of these investments. So that means that if you invest, you borrow somebody money or you lend somebody money and the guy is supposed to pay in the next 5 years. So lifetime ECL requires that you have to look at events that would happen in that 5 years of that period, that event that will happen that might make you lose your money. So lifetime ECL is just is an ECL by looking at all the possible default events that can happen over the lifetime. You will see that will require a lot of estimates, a lot of estimates. You will see a simpler way of doing evaluation. But 12-month ECL, this one is saying, okay, why not restrict it to 1 year? It will be easier like that and a bit less assumption. So this is saying that look at a loss, estimate a loss that can arise from default events within 12 months. Default events from the day you borrow the money, look at possibility of a default event within 12 months. So ECL is either you are making a lifetime ECL or a 12-month ECL. So as far as this impairment is concerned, I've mentioned two things that are very important to you now. Number one is the fact that impairment model we use in IFRS 9 is called expected credit loss model. That's the first thing that's important to us. Number two is that there are two types of it. Just to make, because it requires assumption, is a forward-looking approach. We are looking at, okay, are we going to lose this money or not? We are not waiting for us to lose the money before we start making impairment. So we now said, okay, is it that you are making a lifetime ECL, which is that, okay, let's estimate a loss based on all possible default events that can happen over the life of these investments. And number two is 12 months ECL. Let's estimate a loss or impairment loss by looking at any possible default event within 12 months. So the two, we are still looking forward. It requires a lot of assumption, but at least you can make some estimates. I mean, in Nigeria now, if you invest, you should be able to sit down based on government policies, based on historical data. You should be able to estimate what will happen in this country in the next 1 year reasonably. Looking at what is happening in the energy sector, looking at what is happening in the security sector, you could estimate now, okay, my money is safe, or your money is not safe, like that. And depending on the type of instrument you're investing in, anyway. Okay, so let me not lose focus. Okay, having established this, that impairment is either 12 months ECL or lifetime ECL. So how do we then deal with this? Now, when you want to recognize impairment loss, there are 3 stages involved. There are 3 stages. There are 3 stages involved. In stage 1, immediately you invest in debt instruments. Immediately you originate or purchase a debt instrument, you must recognize impairment loss. And that impairment loss you recognize is a 12-month ECL. That is, you should have sat down and look at possibility of a loss that could happen within 12 months. Like, are there any default event that can happen? And it's very straightforward. So usually what people do in practice is that they will just estimate a rate, maybe 2% or 1%. They call it 12-month ECL. So, and the accounting is very straightforward. what you debit, what you credit. It's very straightforward. And I think somebody should be able to tell me. Is there anybody here that can tell me? Let's say what you invested is you invested 100,000. You know that 100,000, the date you invested, you will debit your financial assets credit bank. Impairment loss is saying that immediately you need to recognize a 12-month ECL. Immediately. Immediately. If you have an office that you work with as an accountant, you're not doing this, you're wrong. You need to do this. But that does not mean that you can decide that the rate is 0%. You can say that, okay, from default event I've looked at within 12 months, you are safe. That means no impairment loss. So, but if you are able to come up with an impairment loss, who can tell me what will be the double entry? It's 12 months ECL. Anybody? Anybody?
I know it's like a provision, so you're debiting P&L and you're crediting something like um it's a provision, so a payable should be a payable, so that when you eventually realize it, you debit it and credit. So you debit P&L and credit a payable, right? Then say liability.
Okay, good. You are correct, actually. So you have two options, right? Number one is to debit P&L. Impairment loss. You call it 12 months ECL. P&L. The corresponding credits, you can call it accumulated impairment loss, because at the end of every year, you'll be reassessing it. So you credit accumulated impairment loss. You see, that accumulated impairment loss, just like the way we deal with accumulated depreciation, at the end of the year, you just go and remove it from the financial asset so that you have a net financial asset. Alternatively, another person might not remove it from financial asset. They will just go and put it under liability. But the best practice is to remove it from the financial asset. That's better like that. So that's the double entry for that. So when you are now recognizing interest revenue on these your investments, the interest is still calculated on the gross carrying amount. Okay, not on the net, is the gross. So you're not, even though you're removing the impairment from the financial assets, you won't calculate the interest on the net. You calculate it on the gross, because it's not like you have lost the money, right? So at origination, 12 months ECL, your interest revenue will still be on the gross carrying amount. So no issue. That's stage one. So immediately you would invest, you classify that financial asset as stage one for impairment purposes, and you make it 12 months ECL. Now, you see, at the end of the year, you would need to classify at stage two. At the end of the year, you need to classify it as stage two if the credit risk has not increased significantly, then you continue to recognize your 12 months ECL and it will still be at stage one. So you still continue to do your 12 months ECL if credit risk has not increased. And I need you to understand that, in fact, before I get there, however, if the credit risk has increased significantly and is not low, then you switch to a full-time ECL. You will switch to a full-time ECL as credit risk has increased. So that one, full-time ECL, this is where stage two starts actually. But for simplicity, I will just tell you that stage 2, take it to stage 2 at the end of the year. So, but if the credit risk has increased, make a full lifetime ECL. Okay. But if the credit risk has not increased, continue to do your 12-month ECL. But the main question is this: the interests, even when the credit risk has increased, interest is still calculated on gross carrying amount, even though the credit risk has increased, but you are still calculating your full interest. The reason is that the guy has not defaulted. It's not like he has defaulted. So you will not consider the impairment loss when we are determining our interest revenue because he has not defaulted. Okay, having said that, I think the key thing is this: how would you know that credit risk has increased or it has not increased? Because in the exam, it's not like they might tell you directly that, okay, credit risk has increased. Then you know that you make a full lifetime ECL. But in most questions I've seen, they don't tell you. And how would you know? The way you will know is the macroeconomic environment of the country where that company operates. If it's unstable, whether there is a war or there's a government policy that will affect businesses, or uh, there is management problem with that company. Like we're talking about both at micro level on the company and at the macro level for the country where they exist. If there are uncertainty around it, if there is tension in the environment that can affect their ability to generate cash flows in the future, that's credit risk increasing. Because when we say credit risk, is the risk that you will lose your money. It is the risk that the borrower might default. So is the environment we look at, and that is how we judge that credit risk has increased or not. Now, having mentioned that, when it has increased, you make a full-time ECL, full lifetime ECL. If it has not increased, you continue making your 12-month ECL. But it's already at stage 2 at the end of each year. Don't forget, your interest in both cases is still calculated your gross carrying amount, just like you have done for stage 1. Now, stage 3. So if the credit risk of the financial asset increases to a point that it is considered credit impaired, then you put it in stage 3. Do you know what credit impaired means? It means that the guy has defaulted. He has defaulted. So he did not pay when he's supposed to pay. He defaulted. Maybe he's supposed to pay at the end of the year. He did not pay. He did not pay back our money. Immediately, you classify it as stage 3. And in that case now, interest revenue will now be on amortized costs or the net carrying amount. That is the gross carrying amount minus the loss allowance. So that means interest will be on the net. You will not be calculating interest on something that you have lost already. So it will now be on the net amount. And of course, your impairment loss will still be lifetime ECL. So, and you see that at this stage now, you need to individually sit down on the financial assets one by one so that you will know which one of you that you have lost, right? You need to assess it one by one. Because at this level now, they have defaulted, so you can easily know the ones that have defaulted. At stage two and stage one now, you don't have to sit down, especially for those companies that have plenty investments, portfolios of investments. Those ones now, at stage one and stage two, knowing whether to classify at stage one or stage two, they can do that on portfolio basis. You don't have to look at investment by investment. But as soon as there's a default event or there's credit impairment, then you need to know which one has actually defaulted. And you would direct the impairment loss to that one primarily. That is it for impairment loss. So nothing much about it. But there is one more thing before I look at this question that I need to make mention of. So if you look at this thing now, they said ECL should be recognized for financial assets that are measured at amortized costs and at fair value through OCI. You will see that they did not mention fair value through POL. That means we don't impair fair value through POL. You need to note that. That's what I need you to know here. That's what really what concerns you here. So you impair, of course, lease receivable, contract assets, and all that. But the major thing I need you to, because when I was teaching you classification of debt investment, I told you three: amortized cost, fair value through OCI, fair value through POL. But yeah, they only mentioned two. That means the third one, you do not recognize impairment loss or ECL for that, for the third one. Okay.
Excuse me. They didn't mention, is it because that fair value through PLL is based on active trading and each trade using fair value, so it's actually being somewhat remeasured all the time and the difference is being expensed to PLL. Is that why it's not included there?
That's perfectly correct. That's perfectly correct. As a matter of fact, they're already recognizing impairment loss on that one already.
Yeah, because it's being written, okay, for the differential.
Yeah, to PRI. Okay, let's look at this question here, just to emphasize my explanations. So this company now, Bailco, has a portfolio of 50,000 financial assets that have 2 years to maturity and are correctly accounted for at amortized cost. Each asset has a coupon rate of 10% and the effective interest rate is 10%. Okay, so this guy invested 50 in debt, 2 years maturity, and he's supposed to collect interest of 10%. Okay. Second paragraph. They said no previous loss allowance has been recognized as the 12-month ECL was assessed to be nil. So that means at origination, 12-month ECL was zero because they believe there is no loss allowance. And I said, and there had been no significant change in credit risk since the portfolio has been acquired. So that means it has remained in stage one. And that's at the end of the year. So it goes to stage two. Information has emerged that the sector in which the borrower operates is experiencing tough economic conditions. I mean, that's already showing increase in significant credit risk, where the environment the borrower operates is experiencing tough economic condition. Look at the way they put it, tough. It is now felt that a proportion of the loans will default over the remaining loan period, and therefore credit risk has increased significantly. Okay. That means they will make lifetime easier. They now said, after considering range of possible outcomes, the overall rate of return from the portfolio is expected to be 6% for the next 2 years. Look at it. Something that we're supposed to get 10%. Now is 6%. That's a loss. That's a credit loss or cash shortfall. But they said that the debt instrument is not credit impaired. So immediately, that means they are telling us in this question that it's not like this guy has defaulted, though. He hasn't. But for the fact that he's experiencing a tough economic condition, the guy cannot even pay the 10% anymore. He has communicated that he can only do 6%, which is fine. They now said we should calculate the lifetime ECL and the loss allowance required. Okay, of course. Since it's stage 2 and the credit risk has increased significantly, so of course we'll make a lifetime ECL. So how do we do this? Since the lender, what we were expecting before per annum is 5,000, which is 10%. That's what they said they would done. That's the contractual cash flow. That's what we're supposed to get. But now we are only expecting 3,000, which is 6%, right? So 6% times 50,000. So there's a cash shortfall of 2,000 per annum. We just need to get the present value of that. That gives me my lifetime ECL. Look at it. Just the normal discounting. I will have used annuity factor, but since this one is 2 years, so I can do year 1, 2,000, use my discount factor, 1 plus r raised by minus n, which is 1.1 raised by minus 1. Give me one this year 2, 2,000, 1 plus r raised by minus 2. By the time you add the two together, you have 3,471. And this 3,471 is my impairment loss. That's my ECL. So with this ECL, I debit P&L, I credit, I would offset it against my financial asset. And that's how you do it at the year end. So at the end of the next year, even though they didn't ask that one, you would reassess it again and see if there's any change. Should we increase this impairment loss or should we decrease it like that? So they will remeasure it again and see, depending on what is happening in that economy. But as far as this year is concerned, this is the impairment loss or loss allowance for that year. Now, okay, let's look at this other one.
Please, there's a clarification. For this question,
Yeah,
if the reduction in that return is, say, in year 3, let's say the question covers maybe a 10-year span, and it's in year 3 that the rate reduces from 10% to 6%. So that means in calculating this contractual cash flow shortfall, it's
yeah,
from year 3 we will start, not that we'll revise
no,
year
no,
1 and year 2. This lifetime ECL will now be based on year 3 going forward, sort of.
yes.
I'm just
So
curious, please.
it will start from year 3. It will start from year 3, right? But the thing is that most questions you will see is from the present year they will give you if they want to set it in this order, because that's when we will have known how much we will get. How much we will get. So, but if they now give you for the future that, okay, this is what we will start losing from the next 3 years, that this is what we'll get. If we are getting the full amount now, we are not there, there's no cash shortfall now. So there's no impairment loss for now. Until when there is cash shortfall, then we will now start recognizing that impairment loss on a yearly basis. Okay, let's look at this one. It said Asset Bank operates in Nigeria, a region in which agriculture is a significant industry. The bank provides personal loans and mortgages in the region. The average loan to value ratio for all its mortgage loans is 75%. Okay, so this first paragraph is talking about a company that operates in a region where agriculture is significant. And because it's a bank, it provides loans and mortgages. And they said average loan to value ratio is 75%, which means that the loan, people would usually drop security when they want to borrow money. So the value of the security is higher than the loan. So loan to value is 75%. So which means that if the value of the asset the person provides as security is 100 naira, that means the loan we are providing is like 75 naira. That's loan to value ratio. I don't think we don't need that in this correction, but I mean, you just need to understand it since they mentioned it. Now, they said all loan applicants are required to provide information regarding the industry in which they are employed. If the application is for a mortgage, the customer must provide the postcode of the property, which is to serve as collateral for the mortgage loan. Okay. Asset Bank applies expected credit loss model in IFRS 9. The bank tracks the probability of customer default by reference to overdue status records. In addition, it is required to consider forward-looking information as far as that information is available. Asset Bank has become aware that a number of farmers are losing revenue and profit as a result of Boko Haram unrest, and several are expected to close. How should Asset Bank apply IFRS 9 to its portfolio of mortgages in the light of changing situation in the agricultural industry? You see, this last paragraph already shows that there is tension in the environment where the people who is giving money to, where they operate. So you should just classify all the loans to stage 2. And that's what this solution is saying, that Asset Bank should classify the financial asset as stage 2. Because a number of farmers are losing revenue and profits as a result of Boko Haram unrest, which signifies a significant increase in credit risk. So Asset Bank will make a lifetime ECL, and interest revenue will still be calculated on gross carrying amount. This last paragraph is what shows us that there's a significant increase in credit risk. Now, a follow-up question now says that later in the year, more information emerged, and Access Bank was able to identify particular loans that defaulted or were about to default. How should Accept Bank, how should Accept Bank treat these loans? Okay, so they say later in the year, more information are emerged, and Asset Bank were able to identify loans that, okay, now there's a default. Now there is a credit impairment.
Credit impairment.
Yes. So that means immediately we'll classify it as stage 3. Immediately, stage 3, because the fact that they have defaulted, it signifies that the credit risk have increased to the point of credit impairment. So this guy will still make lifetime ECL, and interest will be calculated on amortized costs, which you can also call net carrying amount, which is your gross carrying amount minus your credit loss allowance. Okay, so that is that for that question. Now, before I'm going to stop here for today because I think I have kata. So yeah, I need to make a point here about trade receivables because trade receivable is a financial asset too. How do you impair that? So IFRS 9 allows a simplified approach for trade receivables, a simplified approach for trade receivables. And in the sense that you don't have to follow everything I've taught you so far. So you don't have to be doing 12-month TCL and all of that. All you just need to do is use like which we popularly call it aging schedule. Okay, like age receivables lists. I mean, just like this question now, days overdue. If there's no days overdue, meaning the guy is not owing yet, he has not defaulted. He has not defaulted. We told him to pay in 60 days, and the 60 days has not elapsed. We can say, okay, let's make a loss provision of 1%. We can say, okay, oh, if this guy has now defaulted, meaning the overdue is now between 1 to 30, let's increase our loss provision to 5%, and on like that. So this allows a simplified approach. You just need to know, okay, where does your receivable falls? And that will dictate how you calculate your impairment loss. And that's basically what this question and this solution is looking at. And even this question also, which I will implore you to look at. And the last time I can asked this was around March 2020, long time ago. And if you look at the requirement of this question, it says that you should comment briefly if a loss allowance for ECL is to be maintained by the bank in relation to the financial instrument measured. Okay, this particular question, this one is not relevant. What is relevant is just this one. So they said in addition to the investment in debt, the bank has also investments in investment that are classified as fair value through POL. The gain or losses on these investments are recognized in the POL. The directors do not recognize loss allowance for ECL on these investments. So comment briefly if a loss allowance for expected credit losses is to be maintained. So these 7 marks. Again, the first thing you need to do is to
No.
explain the principle. That's the first thing. Explain ECL. The ECL is a possibility that we might lose our money, even though we have not lost it. And is either we make a 12-month ECL, which is a loss based on possible default events within 12 months, or lifetime ECL, which is a loss based on possible default events over the lifetime of the instrument. And when in making loss allowance, you need to classify the financial assets into into 3 stages. Stage 1 at origination, or when you purchase the financial assets, and at this stage you make a 12-month ECL. Stage 2 is at the end of each year, and if at the end of each year, and if there is increase in significant credit risk, then you make a lifetime ECL. But if there is no increase, you continue with your 12-month ECL, and interest is calculated on gross. However, where where there is a credit impairment or there's a significant increase in credit risks that resulted in credit impairment, that is where there is a default event, then you classify as stage 3. And at that stage, you make a 12-month ECL, and interest is calculated on amortized cost or net carrying amount, which is gross carrying amount minus loss allowance. That is what will give you most of the marks, the principal. Having mentioned that, you now go back to the case that since the bank classifies the investment at fair value through P&L, it does not have to recognize a loss allowance for financial assets classified at fair value through P&L because they are measured annually, and losses and gains are already captured in P&L. So that is it. That will give you your 7 marks. Okay, so we're going to stop here for tonight. So
No, the
next,
second question advises the fair value hierarchy.
I haven't taught you fair value, so that's why I just
Okay.
intentionally left it.
Okay.
So that's the next topic I'll teach you. IFRS 13, fair value measurement. This one too is very short. It's something I will have done, but let me do it fresh. So it's a very short topic that we will do, and we'll combine it with maybe IAS 21. I'm not sure I'll do IAS 21 because I don't want to do IAS 21 when everybody is tired. So if that fair value takes me, let's say 40 minutes or 1 hour, I'll probably, instead of IAS 21, I'll most likely do maybe IAS 36. That one is a simpler topic. Then I'll do IAS 21 fresh. Okay, guys. Thank you very much.
Please, I have a question. That you showed us how to calculate the lifetime ECL, but for the
Yeah.
12-month ECL, would they give us a rate for that? Or is it
Yes.
just judgments, or how do we get that for that
See,
12-month ECL?
in reality, is judgment. It's just an estimate you would make based on experience. In reality, in the exam, they will give you a rate in the exam. They will give you a rate. They will tell you how you would compute it. But they don't want you making estimates. That would be difficult for the examiner to mark when everybody is making their own estimate. So that's how it works.
Okay, thank you.
I will see you guys next week. Thank you very much. Have a wonderful night.